Okay, we are here on balance of payment, and let's continue from here. Then balance of payment is about the fifth or the sixth theme in international economics. So we are talking about this. So the fourth, so actually the fourth theme that reoccur or that we continuously talk about in international trade and international economics is balance of payment. Okay, so as I said, trade deficit, you are by now you are familiar with trade deficit, right? We've said, for example, the US is in a huge trade deficit, right? Because US has higher import than export. Okay, then when you have higher import than export, then we say there is a trade deficit. Okay, and there is a trade surplus when a country has higher exports than imports. Okay, then as I've said, for example, for the last several years, China and South Korea has a higher trade surplus. Okay, then as I've already explained, the case with Korea is okay, because Korea has defended its case that this trade surplus is imposed on Korea, but China has created the trade surplus, right? Because as I've said, China regularly devaluates its currency, right? So when you devaluate your currency, devaluation means to decrease the amount of exchange or to decrease the value of your currency. Okay, so when a value of a currency is lower, which means, let's say you have been buying this for $1, then you can devalue your currency and sell this at a lower amount of money. Okay, so which means those investors who used to buy this product from other countries now will buy this product from your country, because the price of this product in your country is less expensive as compared to the other countries. Okay, so by devaluating its currency, China has increased its export. Okay, so that's where the trade surplus came. So that's why the US and China have this trade conflict, because US is saying China is intentionally devaluating its currency and creating this trade surplus. Okay, and the other point is the balance of payment. Okay, so there is what we call a positive trade balance and negative trade balance. Okay, so this means trade balance, as I've said, there are several factors that affect the balance of payment. Okay, so one of them is the import and export. And there are also other means of affecting or other factors that affect balance of payment. For example, the foreign direct investment. Okay, so we'll talk about this in detail. So governments measure the value of exports and imports, as well as the value of financial assets that flow into and out of their countries. So what are the financial assets? Financial assets could inflow or outflow from a country because of different reasons, because of capital markets, let's say. So capital market is when individuals give money, or when individuals invest in something that other firms would like to or would like to have more cash inflows. So I will talk about that. For example, an investor in Korea might buy stocks or bonds in the US. Okay. So stock is a share, as you know, but bond is you lend money for an interest rate. It's not an ownership, or it's not being a shareholder, right? But stock is a shareholder. So this means there are investors, Korean investors that invested in stocks and bonds in the US. So which means when these stocks and bonds in the US are making very good money, that is good thing for Korea, because the investors are Koreans and this money is going to come back to Korea, right? So you can also balance your balance of payment by using other financial assets and bringing cash flows into the country, right? So trade deficits are created where countries import more than they export in value, right? So maybe offset by net flows of financial assets. As I've said, this higher imports and lower exports can be offset, just like the US, by other financial assets, like in foreign direct investment or other capital markets, okay? But still, as we have said, for example, US has a huge trade deficit, okay? But it doesn't mean that the US economy is in a bad shape, right? US economy is the world's greatest or the world's biggest economy, right? It's not because of the trade deficit, but they also have, or they offset this trade deficit by other net inflows of our financial assets, like the foreign direct investment they have in Europe, and also the inflow of financial assets that comes from capital markets, okay? So you can offset this trade deficit by other means. Then the other thing is the official statements balance, or the balance of payments measure the balance of funds that central banks use for financial, for official international payments. So all these three values, the trade, import and export, the trade deficit, and also the balance of payments, are measured in the government's national income account, okay? And countries or a nation can evaluate its economic status based on these values also, okay? Then let's talk about exchange rate determination. So how can a country determine its exchange rate? Exchange rate for the currency, okay? So for example, Korean won today, $1 could be exchanged for 1,100 Korean won today, right? And tomorrow, $1 could be exchanged for 1,200 Korean won, okay? And the day after tomorrow, maybe 1,300 Korean won, okay? But the question is, who do you think is determining the exchange rate, okay? Who is saying that $1 is equal to 1,100 Korean won, or 1,200 Korean won, or 1,300 Korean won? Who do you think is responsible body to determine the exchange rate of a currency, okay? So that's the question. But we will discuss in detail about this, but one example I can tell you is an exchange rate could be fixed, or an exchange could be floating, okay? Fixed means it will be fixed by the government, by the Bureau of National Treasury and other offices. They come together, they discuss based on the import and the export they have, they determine the exchange rate. And also they have to talk to other countries also. As we have said, if you devalue your currency intentionally, so that would result in a conflict between nations, okay? So it could be fixed amount of exchange rate, but you can also let the market determine your exchange rate. That is called floating exchange rate, okay? So the market determines means, so based on the import and export and these financial transactions, that there is a huge database of this financial transaction, okay? So this financial transaction by itself will determine the exchange rate of a currency of a country. Okay, so for example, if Korea is having a very good international trade and exchange of financial transaction between other nations, then the economy of a country, Korea will be strong, right? And when the economy of a country is strong, then the exchange rate for example, a dollar for a won will decrease, right? So maybe one US dollar will be 1,000 Korean won or less than 1,000 Korean won. So that implies the economy of the economy of Korea is in a good shape. Okay, but if the exchange rate for $1 is increasing, then that shows that the economy of Korea is not in a good shape, right? So anyways, there are different means of determining exchange rate. As I've said, you can use fixed for a period of time, like for a week, 2 weeks, a month, I don't know. You can fix the amount of exchange rate for your currency, or you can just use the market to determine. A market determining exchange rate means the exchange rate of the currency will depend upon the country's import and export and other inflows of financial assets. Okay, so that actually that is floating. Floating means it changes within minutes or within seconds. Okay, because the exchange rate will be determined based on the export and import within the country. Okay, so exchange rates are an important financial issue for most governments. Okay, so determining exchange rate is very important. Okay, and having a good exchange rate determination system is very vital for the economy of a country. Okay, so exchange rates measure how much domestic currency can be exchanged for foreign currency, and thus affect how much goods dominated in foreign currency or imports cost in the domestic country, and how much goods dominated in domestic currency exports cost in foreign markets. So as I've said, okay, exchange rates means how much Korean won is exchanged for $1. Okay, so how much is $1 in Korean won? That's the exchange rate, right? And that determines or that affects the import and export of Korea, actually, right? So for example, if $1 in Korean won is 1,500 Korean won, okay? So this means the value of the currency of Korea is decreasing, okay? So when the value of exchange rate increases, I mean, when the exchange rate increases, like as I've said, $1 of Korean won, I mean, $1 of the US dollar, $1 of the US is equal to 1,500 Korean won. It's higher, right? So this means dollar is strong and Korean won is weak. Okay, and if $1 is only 900 Korean won, then that means Korean won it is getting stronger and dollar is getting weaker. Okay, so let's come back. If $1 is exchanged for 1,500 Korean won, that means $1 can buy so many things in Korea, right? So this will increase the export of Korea, right? Because now goods in Korea will be cheaper, because now the US dollar has a higher value than Korean won, right? So Korean exchange will increase because now so many other countries will buy Korean products because Korean products are now cheaper, right? But if $1 is equal to 900 Korean won, this means Korean won is now very strong, right? And dollar is getting weaker. So this will increase import to Korea, because now Korean won is very strong. Korean won can buy products from the US or other countries because the value of Korean won is higher as compared to other currencies, right? So decreasing or increasing exchange rate value will determine the import and export of a given country, right? So we will also discuss in detail about this, okay? So some exchange rates change continually. That is when you have floating exchange rate determination. Then others might have fixed exchange rate determination, which is fixed for some time, okay? And the other term here we have is international policy coordination. So the thing here is, as I've said, a country cannot just uh, fix the exchange rate by itself, okay? They have to talk with each other and they have to agree, because devaluating, or when countries intentionally decrease the value of their currencies, then they affect the international trade in other countries, and that creates a conflict between nations, okay? So there has to be policy coordination among nations, right? So an integrated economy, one country's economic policies usually affects other countries as well, right? So leading to the need for some degree of policy coordination among each other, right? So this depends on the type of exchange rate regime. So if you're using floating or fixed, then you have to negotiate and you have to coordinate with other nations and fix your exchange rate and other international trade policy issues, so that you cannot harm each other, okay, in the exchange of goods and services. And the other is capital markets, where money is exchanged for promises to pay in the future, have special concerns in international setting. So not only capital markets, there are also what we call future markets. So this means, as I've said, a company in Korea might buy supplies from a company in the US, okay? So let's say this company in Korea has bought $500 million supplies of materials from a company in the US. Okay, what usually happens is you don't just pay the money. Okay, you might agree or sign a contract with your supplier to pay this money in the future. Okay, but when you sign a contract, you sign on the exchange rate also, right? Because the exchange rate now and the exchange rate after a year could be very different. Okay, so let's say you bought this raw materials from, or supplies from the US now, and you are signing a contract to pay for these raw materials after a year. Okay, so which exchange rate are you going to use? The exchange rate of Korean won to dollar today, or the exchange of Korean won to dollar after a year? Okay, so that is a contract that you have to negotiate. Okay, you have to negotiate the interest rate, the exchange rate, and other factors that affect the value of money in your contract for the future. Okay, so because of currency fluctuations can also affect the value that you are going to pay for your supplier. Okay, so countries, especially the developing countries, might default on debt. Okay, because their currency fluctuates very much as compared to developed countries. Okay, so if you compare developed and developing countries, currency rate fluctuation means the rate of exchange rate. I mean, the rate of exchange in, for example, in Korea is much better or stable than compared to exchange rates of currency in Africa. Okay, then this implies that a country is better off trading with a business in Korea than trading with a business in Africa, while signing a future or capital markets contract. Okay. Because if a currency rate is very much fluctuating, then it is very difficult to predict the exchange rate value of the currency after a year or 2 years. Okay, and as I've said, usually investors they take very much care when they trade with developing countries, because the exchange rate fluctuations might affect their return on their investment. Okay. And continuing, so capital markets are arrangements by which individuals and firms exchange money now for promises to pay in the future. Okay, so capital markets could be in the form of stocks, where you buy shares of a company, or it could be in terms of bond, where you lend this money to government or to any business on a promise of an interest rate for those bonds that you have bought from the company or from the government. Okay, and also, as I've said, there are future markets where you agree on amount of exchange rate, interest rate that you're planning to pay in the future. Okay, then international capital markets cope with special regulations that countries impose on foreign investments. Okay, so special risks of currency fluctuations might be there. Sometimes they offer opportunities to evade regulations placed on domestic markets. So we'll talk about this in detail when we talk about their impact on um, um, the economy of the country when it is very much fluctuating. Okay, and the last thing in this chapter is the third objective is to talk about trade and monetary transactions, or what is the difference between international trade and international finance. Okay, so just put in one sentence each. Then international trade, as we have said, focuses on transactions involving movement of goods and services across nations. It's across nations because it's international, right? And international finance focuses on financial or monetary transactions across nations, international finance. So international trade is different from domestic trade because the movement of goods and services is across nations, while in domestic trade it is within the nation, right? And international finance is a monetary transaction across nation, while domestic financial transaction is a money transaction or monetary transaction within a single nation. Okay, so in international trade theory, we'll talk about chapters from 2 to 8. We'll be focusing on this, and international finance issues will be also talked in detail in 2 and 7, and also in 9 and 19 to 10. We'll not go far to those chapters, but as I've said, the topics in this course are majorly divided into two: international trade theory, international trade policy. Then in the first few weeks that we will be talking about international trade theory. Then after midterm exam, we will be talking about international trade policy. Okay, so that's all I have for this chapter. If you have any questions, then you can ask these questions, or you can post these questions on the portal, so that I will come back to them next week. Okay, or if you are comfortable, then you can just I will enable the voice so that you can just ask any questions. Okay, and at the same time I will be taking attendance this time. Okay, I have about 15 students, so I will be checking attendance, and let me know if you have any questions. If no, then I will stop here, and I will see you all next week. Then if you have questions, let me know through my email address. Okay? So thank you very much for having me, and have a good day. See you next week. Okay? Bye.